In this video, we are going to talk about stock market investing for beginners, a step-by-step guide to building wealth. So before starting this video, please like this video and subscribe to our channel for future updates. Purchasing stock to invest in entails acquiring ownership interests in public companies. The little shares are referred to as the company's stock, and by purchasing that stock, you are betting on the company's long-term success and growth. When that happens, your shares may become more valuable, and other investors may be prepared to buy them from you for more than you paid for them. That implies that if you choose to sell them, you could make money. Having a diversified investment portfolio and continuing to invest despite market ups and downs is a smart rule of thumb. Putting money into an online investment account, which can later be used to buy shares of stock or stock mutual funds, is one of the greatest ways for novices to learn how to invest in stocks. You can open a brokerage account and begin investing for the cost of one share in many cases. Some brokers also provide paper trading, which enables you to practice buying and selling stocks using stock market simulators before making a real money investment. Here is the list of the 6 business ideas to make you $1,000 a day. Let's start. Number 6. Manage your stock portfolio. There will be moments when you need to check up on your stocks or other investments, even though worrying over daily changes won't do much for the health of your portfolio or your own. If you use the following techniques to acquire mutual funds and individual stocks over time, you should periodically review your portfolio to make sure it still meets your investment objectives. Some things to think about. If you are close to retiring, you might want to convert some of your stock assets to more conservative, fixed-income investments. Consider purchasing stocks or funds in a different sector to increase your portfolio's diversification if it is overly concentrated on one industry or area. Finally, consider geographic diversification as well. Vanguard advises having up to 40% of your portfolio's stocks be foreign stocks. To have this exposure, you can buy global stock mutual funds. Number 5. Focus on investing for the long term. One of the most effective strategies to increase money over the long run is through stock market investments. Throughout several decades, the average annual return on the stock market has been around 10%. But keep in mind that's simply an average for the overall market. Some years will be up, some down, and the returns on specific stocks may vary. No matter what is happening on a day-to-day or annual basis, for long-term investors, the stock market is a smart investment because they are searching for that long-term average. If you begin investing in stocks or mutual funds, the smartest course of action may also be the most difficult. Don't look at them. Avoid the behavior of obsessively checking how your stocks are performing unless you are trying to beat the odds and be successful at day trading. Number 4. Choose your investing account. After deciding on your investment strategy, you should pick a starting investing account. Choose whether you want to handle it on your own or with professional assistance. You can look into it if you wish to invest passively and do it yourself. Robo-advisors that utilize algorithms to make investments for you include Betterment and Wealthfront. Create a brokerage account with Vanguard, Fidelity, or a comparable company. If you wish to begin actively investing, you can make use of employ actively managed Vanguard funds and also utilize actively managed funds from Fidelity. You should think about several aspects when deciding whether to invest actively versus passively and whether to do it yourself or hire a professional. Consider the overall costs, the time commitment, and any account minimums. The most important step is to open an investing account. Select one that works with your spending plan and investment philosophy, and then make your first deposit. Please keep in mind that at the time of submission, your funds are in a cash settlement account and not yet actively invested. Number 3. Get acquainted with various stocks and funds. It's time to start looking into potential investments. Researching the stock market is worth your time because there are many various ways to invest in it, and there is a lot to learn. If you wish to invest in particular businesses, stocks are a wonderful choice to take into account. Look at the company and financial statements before choosing a stock and base your decision on the bucket. you are seeking to fill in your portfolio. For instance, are dividend stocks what you are looking for? Investigate the dividend history. Do you want to buy a growth stock? Examine the earnings per share. Does it consistently indicate growth? Think about how these metrics compare to its peer group, advises Amy Irvin, a CFP expert from Rooted Planning Group. You should familiarize yourself with the numerous kinds of investment vehicles and comprehend the advantages and disadvantages of each kind of security. For instance, equities carry a high-risk, high-reward potential. As we previously discussed, index-based ETFs and index funds are passively managed, while mutual funds are actively managed. This is crucial to remember because your fees and obligations change depending on whether you choose an active or passive strategy. Mutual funds may have higher fees and are professionally managed. You can buy ETFs and index funds on your own, and they can have reduced fees. You can reduce your risk by diversifying your investments and avoiding putting all of your eggs in one basket. Number 2. Determine your budget. Once you have established some sound objectives, it's time to analyze your spending plan. You can use a retirement calculator, for instance, to determine how much you could need and how much you should save each month if you have 30 years to save for retirement. While creating a budget, be certain that you can stick to it and that it will enable you to achieve your objectives. How much debt do you now have? List your monthly expenses and contrast them with your income. Your total assets less all of your liabilities equals your net worth. This figure might help you see where you stand financially and provide a big picture, an overview of your financial situation. Knowing your goals is vital because it gives your money a purpose, as we have already said. How much risk are you willing to accept? You can better determine how much time frame. How soon do you want to achieve your investment objectives? This is crucial for organizing your funds and ensuring that you know when and how to invest without messing up your budget or other objectives unrelated to trading shares. You can lose if you calculate this. Number 1. Figure out your goals. It is critical to understand your primary objectives and the motivation behind your decision to begin investing. Understanding this will make it easier for you to create specific objectives. This is an essential initial step to take if you want to later develop an investing strategy. If you are unclear about your goals, take a look at your financial condition first. Pay attention to things like your debt load, after-tax income, and anticipated retirement age. Your overall time horizon, or how long you intend to hold onto your investments to achieve your financial goal, you can start determining your investing goals based on that information. Do you wish to make short-term or long-term investments? Do you have money set aside for a down payment on a home, or are you attempting to increase your retirement fund? The amount and level of adversity with which you invest will depend on all of these circumstances. Finally, there is an inherent danger in both investing and life, and it is just as simple to lose money as it is to make it. You should think about your risk tolerance for both your financial and psychological well-being. This is commonly referred to as risk tolerance, or the amount of risk that, given your financial condition and feelings towards risk, you can accept with reasonable assurance, determined by knowing when you intend to retire. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching and see you next time.